What if I told you that there is a way that you can build passive income within the stock market without picking individual stocks? And I've also told you that this is what many wealthy billionaires are doing because it is a smart and low-cost way to diversify your portfolio and secure your financial future. Well, if you read the title, it probably have already given it away, which is index funds. However, you probably want to watch this video to the very end so that you can discover how this one simple investment strategy can change your financial future. What's up, thinkers? Chris Robinson here, reminding you guys to like the video to show your support. And while you're at it, you might as well subscribe as well as take notes so that you can benefit from this free knowledge. Enough talking. Let's jump into the details. Okay, so before we get into the nitty-gritty of index funds, let's first understand what they are. So an index fund is a type of mutual fund or exchange trade fund, aka ETF, that trades a particular market index. For example, the S&P 500 index or the NASDAQ 100 index. When you invest in an index fund, you're essentially buying a tiny piece of every stock in a particular index. Now at this point, you're probably wondering, why would I want to invest in an index fund, right? Well, for starters, index funds offers a simple and easy way to invest into the stock market. And you don't need to have a deep understanding of the market, nor do you need to pick individual stocks. But instead, you can invest into a diverse range of stocks to an index fund and let the index fund do all the heavy lifting. And I know that all sounds good at this point. However, that's not even the best part, because index funds has historically outperformed all actively managed funds. And I'm not even kidding you, because research has shown that over the long run, index funds has generated better returns compared to actively managed funds. This is because actively managed funds have higher fees and expenses, and the fund manager ability to pick winning stocks consistently is sometimes questionable. In fact, those fees associated with an actively managed fund can eat into your returns significantly. However, on the other hand, index funds typically pay lower fees and expenses, which means that more of your money is invested into the market and has the potential to grow over time. Okay, so now let's talk about the benefits of investing into an index fund. One of the biggest advantages is that it offers instant diversification, because by investing into index funds, you are investing into a diverse range of stocks in various different sectors as well as industries. So with that in mind, this helps to mitigate the risk of investing into one or two stocks, which can be unpredictable. But that's not all, because investing into index funds can offer you the opportunity for long-term growth. While we know that the stock market experiences its ups and downs within the short term, historically with the long term, it has tended to be upward. So by investing into an index fund, you are giving your money the opportunity to grow over time, as well as benefit from the power of compounding. So now you're probably at the point of wondering, what are some index funds to consider? Well, there are many index funds to choose from. However, some of the most popular includes the Vanguard Total Stock Market Index Fund, which gives you exposure to the entire US stock market and has a low expense ratio of just 0.04%. Next is the iShares S&P 500 Index Fund, which gives you exposure to large established US companies and has a low expense ratio of just 0.03%. And another good option is the Schwab International Index Fund, which gives you exposure to developed international markets, and it also only have a 0.06% expense ratio. Now that I've shared a few index funds with you, you're probably wondering, how do people actually make money with these index funds, right? Well, the answer to that question is quite simple, because you make money when the value of the index fund increases. And like we mentioned before, investing into an index fund diversifies your portfolio and lowers your risk. So over time, historically, we learned that the market tends to go up, which means that your investments will go up as well. Take the S&P 500 for example. Over the last 30 years, it had an average annual return of about 10%. That means that if you have invested $10,000 in the S&P 500 index fund over 30 years ago, today you would have earned $174,000. So just to sum it up, investing into an index fund could change your financial future, because by investing into an index fund, you diversify your portfolio as well as lower your risk. And with the low fees and easy access, it has never been easier to invest into your future. So what are you still waiting for? Start researching index funds today and take the first steps towards better financial health. Otherwise, that's my cue. I see you guys in the next one. Don't forget to like, subscribe, and show your support. Peace.